They're calling it the new American investing boom. Stocks exploding, crypto roaring back, real estate flipping like it's 2021 again. TikTok is full of new millionaires, and every influencer with a ring light claims the secret to getting rich is in the next 15-second clip. But what if I told you the real story is nothing like what you're hearing online? What if this boom, this rush, this frenzy has winners, but not the ones you expect? Because behind the charts, behind the hype, behind the headlines, lies a very different truth about who's actually getting rich in America right now. And today, we're going to uncover it. America has always had investing booms. The dot-com explosion, the housing rush, the crypto mania, the AI rally. But this new wave feels different. This one isn't driven by a single asset class. It's a cultural shift, a collective decision by millions of Americans that investing is no longer optional. Inflation, wages, cost of living, retirement fears, they've all converged into one massive reality check. Keeping money in the bank means losing money. So more Americans than ever, Gen Z, Millennials, even Boomers, are throwing their savings into markets. But here's the twist. Not all investors are playing the same game, and definitely not all are winning. When people talk about the new American investing boom, they usually focus on the obvious. Soaring stock prices, crypto cycles returning, houses selling above asking price, million-dollar TikTok flexes. They talk about the money, the gains, the charts, the percentage returns, as if numbers alone define a boom. But the truth is far more human than mathematical. To understand what's happening right now, you need to understand how America's relationship with money has changed on a psychological level. Because this boom didn't start on Wall Street. It started in American living rooms. It began with something subtle. Fear. The fear of falling behind. The fear of inflation burning a hole through savings. The fear of working harder but never catching up. This fear wasn't irrational. It was real. As the cost of everything climbed, from eggs to rent to healthcare, people began to realize a harsh truth. Saving money no longer guaranteed security. A savings account had transformed into a slow leak, and that realization created a fundamental shift that economists rarely talk about: the emotional awakening of the American investor. But fear wasn't the only catalyst. There was frustration too. People were tired of hearing stories about others getting rich while they remained stuck. Stories of early Bitcoin buyers turning a few $100s into millions. Stories of Tesla investors who held through the chaos and ended up wealthy. Stories of everyday people who bought homes years ago now sitting on six-figure equity gains. The common thread in all of these stories wasn't intelligence or education or even luck. It was ownership. People who owned assets, any assets, were winning. And people who didn't were falling further behind. Then came the spark. The world locked down, the system froze, and something unprecedented happened. Millions of people, from baristas to teachers to office workers, found themselves at home with time on their hands and stimulus checks hitting their bank accounts. For many, it was the first time in their lives that they held extra cash beyond immediate survival. And as markets crashed and headlines screamed chaos, something unexpected happened online. People began teaching each other how to invest. Forums lit up. TikTok exploded with finance content. YouTube channels offering financial education went from niche corners of the internet to mainstream entertainment. On Reddit, Discord, Twitter, and Telegram, the walls blocking normal people from financial information crumbled. And as the stock market rebounded faster than anyone expected, people witnessed in real time what happens when someone invests at the bottom. They watched fortunes multiply. This was the birth of the new American investor. Not the wealthy, not the privileged, not the Ivy League trained. Everyday people. People who had never bought a stock in their lives suddenly opening brokerage apps, learning terminology, taking risks, and for the first time, feeling something powerful: control. But this is where the story gets complicated. Because the boom didn't unfold the same way for everyone. While millions began their investing journeys, the landscape they entered wasn't level. It was a battlefield with three kinds of players: the hopeful, the prepared, and the dominant. The hopeful were the newcomers, the ones who entered with enthusiasm, curiosity, and optimism. They believed they could change their lives through investing, and in many ways they were right. But they were also the most vulnerable. Without years of experience, they were susceptible to hype cycles, emotional decisions, and the illusion that every investment must move fast or it isn't working. Many experienced wins, but just as many learned painful lessons. Buying at the top, selling at the bottom, confusing excitement with strategy. Still, even these losses served a purpose. They transformed the hopeful into learners. Then came the prepared investors. People with disposable income, stable jobs, and discipline. They weren't flashy. They weren't trying to hit home runs. They simply invested consistently, methodically, and without panic. These investors weren't better because they were smarter. They were better because they had more resources. They could invest during downturns. They could wait through volatility. They could buy when everything looked scary and hold when others were selling. Quietly, without drawing attention, they accumulated wealth at an accelerating pace. And as the boom intensified, so did their advantage. But towering over both groups was the third category, the dominant players. These were institutions, hedge funds, private equity firms, sovereign wealth funds, big banks, and corporations that operate on a scale most people can barely comprehend. Their strategies aren't reactive. They shape the environment. They move markets. They set trends before trends exist. When retail investors rushed to buy tech stocks, institutions had already accumulated positions. When individuals discovered crypto again in 2023 and 2024, institutions had already spent years building custody solutions, lobbying for ETFs, and preparing entry points. When average Americans struggled to buy single-family homes, institutions were buying entire neighborhoods. Every boom has winners and losers, but the American investing boom is unique because the gap between the average participant and the top players isn't just financial, it's structural. Institutions move with data, decades of experience, endless liquidity, and the ability to access opportunities unavailable to the public. They don't try to predict the future, they create it. But here's the twist that almost no one talks about. For the first time in modern history, retail investors aren't entirely behind the curve. They're not perfectly positioned, but they're not powerless either. Technology changed the game. Access to markets is easier. Information is instant. Learning is free. Trading is cheap. Opportunities that once required a broker or financial advisor are now available to anyone with a smartphone. The gatekeepers didn't disappear, but their power weakened. And so the boom became a clash of forces. Institutions accelerating wealth at unimaginable speed. High-income earners quietly building strong long-term portfolios. And everyday people trying to carve out their place in a system not built for them, yet still refusing to sit on the sidelines. This boom is not defined by greed. It's defined by survival. And that's why it's deeper and more emotional than any investing surge before it. People aren't investing because they want Lamborghinis or mansions. They're investing because the world is more expensive than ever. Housing feels out of reach. College feels overpriced. Healthcare feels predatory. Retirement feels impossible. And wages haven't kept up with the price of existence. So Americans adapted. They embraced the only strategy that seems to offer a way out. Invest or fall behind. But the boom isn't just cultural. It's also fueled by tectonic shifts in the economy. Artificial intelligence is redrawing the boundaries of productivity, profit, and growth. AI companies are seeing explosive expansions in valuation, and investors are pouring money into the tech sector like it's the new gold rush. For institutions, AI isn't just a sector, it's an inevitability. For retail investors, it's an opportunity bigger than anything since the internet. Crypto too has evolved. It's not a fringe movement anymore. Wall Street validated it the day Bitcoin ETFs were approved. The moment major banks integrated digital asset custody, everything changed. Crypto is no longer a gamble. It's an asset class. And the new wave of investors pouring into digital assets isn't doing it for hype. They're doing it because they see what institutions see. A global financial restructuring underway. Real estate follows a similar story. Despite high interest rates, property prices continue rising because supply is historically tight and demand remains high. Millennials, the largest generation in US history, reached peak home buying age at the exact moment housing became scarce. Meanwhile, investors, big and small, are competing for limited inventory. That competition has transformed real estate from a personal milestone into a financial arms race. Then there are alternative investments, collectibles, art, farmland, wine, watches. Once reserved for the upper class, now accessible to everyday investors through fractional ownership platforms. People aren't just investing in the S&P 500. They're investing in culture, scarcity, and physical assets that appreciate as the world becomes more digital. This diversification isn't random. It's a reaction to uncertainty. When the future feels unpredictable, people buy anything with historical or intrinsic value. And with each purchase, the boom grows. But the heart of the story is this. The new American investing boom is not about speculation. It's about necessity. It's a generational response to a system where traditional financial advice no longer applies. Work hard, save money, retire comfortably, doesn't match the reality people see around them. The new advice, though rarely spoken aloud, is simple and urgent. Buy something, anything, that grows faster than inflation. And yet, understanding the boom requires acknowledging its duality. On one side, it's empowering. Millions of people taking control of their financial futures, gaining knowledge, building stability, and discovering the power of ownership. On the other side, it's daunting. A landscape where those with more money have more advantages, more options, more resilience, and more access to the best opportunities. Who is winning the new American investing boom? The honest answer is layered. Institutions are winning because they always win. They have the size, the intelligence, and the resources to outmaneuver the market. High-income professionals are winning because they have the means to invest more aggressively and consistently. And retail investors, especially younger generations, are winning in a different way. Not necessarily by outperforming institutions, but by transforming their relationship with money and finally engaging in wealth building instead of wealth chasing. The boom is not a single event. It's a realignment of American financial identity. The young investor with $100 a month going into a Roth IRA is part of it. The millennial couple buying a home they can barely afford because they want equity is part of it. The crypto enthusiast dollar cost averaging into Bitcoin and Ethereum is part of it. The retiree moving savings into index funds to fight inflation is part of it. Everyone, in their own way, is participating in a collective shift toward ownership. This is why the boom feels so different from previous cycles. It's not just happening on Wall Street. It's happening in bedrooms, kitchens, coffee shops, and group chats. Investing has become a cultural force, not a financial strategy. And that shift, that widespread cultural embrace of asset ownership, is why this boom is more powerful, more emotional, and more transformative than anything America has seen in decades. Will everyone win? No. The system is still uneven. The playing field is still tilted. But for the first time in generations, more people are on the field. More people are learning. More people are aware. And awareness is the first step to wealth. This boom isn't a moment. It's a movement. A movement born from fear, fueled by frustration, and sustained by hope. A movement reshaping the financial future of an entire nation. A movement whose real winners won't be determined in months, but in decades. And those who stay consistent, not perfect, not lucky, but consistent, will be the ones who look back and realize they didn't just witness the new American investing boom. They lived it, and they benefited from it. Right now, 3 major forces are accelerating the investing boom. AI companies are hitting all-time highs, pushing tech indices into a new growth cycle. Crypto ETFs continue setting inflow records, bringing Wall Street deeper into digital assets than ever before. The US is experiencing the largest wealth transfer in history, with $70 trillion moving from boomers to younger generations, and much of it flowing into investments, not savings accounts. These forces are shaping a new financial reality, and if you understand them, you can position yourself to benefit. Thank you so much for spending your time with me today. I really appreciate you watching. If you found this useful, a like would be fantastic, and subscribing helps me keep creating content you'll hopefully enjoy. Please share your experiences and any questions in the comments. I always try to read and respond. Your support keeps this channel going. Until our next video, take care and have a wonderful day.